As the stock market continues to go down, which way do you invest for the long term? Hey, this is CEO Trades, where money works for you. Today, we're looking at the stock market and seeing that yesterday's video, I posted a very important video letting you know that right now I'm watching. And why am I watching? Because in the next few days, the news is going to impact the market. At least that's what I believe, and I could be wrong. Remember, I am not your financial advisor. Always seek the help of a professional in order to make the best decisions for you. We're looking today at 7 ETFs. And why are we looking at these ETFs? Very important question. This is the reason. We're going to be looking at these ETFs because they bet on the market in the opposite side. Instead of going long on the upward trending, they can be invested on the short term, going short, meaning going downward as the stock market goes down. What are these ETFs? Well, let's take a look. Number one on these ETFs is SQQ. What is SQQ? Well, as we're looking here on the chart, you can see that in the last year, this is where it stands right now. I'm not going to go too much into the view of the technical analysis as much as I'm looking at a specific article that was posted by Forbes just a few days ago in reference to SQQ, one of the 7 ETFs that I'm looking at. ProShares Ultra Short QQQ aims for 3 times the opposite returns of the NASDAQ 100, which tracks the biggest companies that trade on the NASDAQ stock exchange. If the NASDAQ 100 falls 1% in a single session, holders of SQQQ gain 3%. Is that amazing? 3% instead of just 1%. It's 3 times leverage. That's what it's known as. What's the next one is RWM. This is RWM again. Now, what is the difference between on RWM compared to SQQQ? RWM is the ProShares short of the Russell 2000 ETF. The ProShares short Russell 2000 promises to generate inverse returns for the Russell 2000 stock in over a single day of trading. The Russell 2000 is a market cap weighted index of approximately 2,000 small caps. So if the Russell 2000 declined 2% of the course of a single session, holders of RWM would gain 2%. 2% decline means 2% gain in RWM. The next one is, as we are looking here, is SARK, S-A-R-K. Why is this name sound very familiar? SARK. It is because it is Cathie Wood's main investment, which is over recent years, investor Cathie Wood's flagship ARK Innovation ETF has become a widely popular and wildly controversial fund choice. The Total Capital Short Innovation ETF lets investors bet against the single fund, making it the first inverse ETF ever to target a single fund. SARK strives to return the inverse of ARK's performance for a single trading session. That is amazing. Now, it's a risky one, and this one is very good. Compared to the first 3, I just want to let you know that in the last 3 months, SQQQ has given a 30% return. RWM has given a 0.5% return in the last 3 months. Sorry, 3 months is what I meant to say, 30% for SQQ. And for the last 3 months, SQQQ has given a return of 30% for the last 3 months. RWM has given a 0.5% return, and SARK, S-A-R-K, has given a 7.9%. Now let's take a look at the next 4. The next one is EFZ. EFZ. Give me a second here as we are switching our screen. This is EFZ, and EFZ, compared to the other ones, the ProShares shorts MSCI EAFE, which I used to have a 401k invested in MSCI, but I saw so many losses for many years that I just bailed out from it, aims to generate positive returns that are directly proportional to daily declines in MSCI EAF index. The index tracks the performance of large and mid-cap stocks from more than 20 developed markets. In Europe and Asia, traders who believe that international stocks in developed markets will be seeing a down day can use EFZ to offset losses on a long position. The MSCI index is heavily weighted on 6 major countries: Japan 22%, the UK 16%, France 11%, Switzerland 10%, Germany 8%, and Australia 8%. Why is this important? Because it's not just about US shares now, it's about the index weighted in reference to different countries, and that's one of the reasons why I was invested in these. But this also helps to invest in companies like Nestle, Roche Holding, Shell, and AstraZeneca, some of the power players out there in the market. Now, another one is the SJB. What is SJB? Put it right here. SJB is the ProShares Trust Short High Yield ETF. And what is this one known for? Well, the ProShares Short High Yield Fund targets the inverse daily performance of market iBoxx and money liquid high yield index. The junk bond index tracks dollar-denominated high yield corporate bonds issued by companies domiciled in the US, Bermuda, Canada, Western Europe, Japan, and the Cayman Islands. Day traders who are looking to benefit from declines in the junk bond market should check out SJB. Now, the last one that I want, the last two that I want to look at are TBF. TBF is the next one, and TBF, if we look at the chart just quickly here, TBF, you can see it right there. And in this chart, what is TBF? TBF is basically the ProShares Short 20+ year Treasury Fund aims to deliver the opposite daily return of the ICE US Treasury 20+ year bond index. The prices of lower term Treasury tend to be more volatile than short-term treasuries. With rising interest rates, long-term treasury prices are heading lower, which provides a great opportunity for savvy traders to make good use of TBF. The last one that I want to look at is SPXS. SPXS is, hold on, let's bring up this chart. SPXS, this is the last one we're looking at of the 7 inverse ETFs out there. This one is the Rexion shares, and the Rexion shares S&P 500 Bear 3 times ETF is one of the most popular ways to shorten the US stock market. When you buy shares of SPXX, you're aiming to profit from declines in benchmark and S&P 500, which for professional investors is the most common stand-in for the entire US market. These are my 7 that are given through Forbes. And just so you're aware, SARK again in the last 3 months has given 7.9% return. The EFZ has given 10.2%. SJB has given 4.7%. TBF has given 21.5%, and SPSX XS has given 12.2%. Obviously, the winner of the 7 that has given the most is the SQQQ, which has given 30% returns. Now, even if you don't invest in these, did you know that there's an advantage to following these? Because the more you are infused in noticing information, you can wager where the market is headed. You can follow the news, you can follow the chart. There are many ways to benefit from this. Now, these 7 are out there for those of you who want to be able to trade instead of going long. You go short for the short term. Be very careful in going long with these. You could lose money, you could make money. When is the best time to invest in these? Well, when you believe that the market's going to go down. I posted a video yesterday, and I will put it up here in the link again, so right now, so that you can click on it and hear what I said yesterday, and maybe take a bet on the opposite of what you normally do. This is CeoTrades. If you want to invest in your bank account, why don't you invest in your knowledge account so your money market account will grow, multiplied, stay safe, and until tomorrow, we'll look at another part of the markets.